I don't know that things are. I'll just say that Aaron and I, neither one of us has a whole lot of positive to say right now as it concerns any agricultural markets. I guess corn is probably the most positive from the state, from the standpoint of Tennessee, and that most people probably were able to get crops in, and they're benefiting from a negative aspect from the Midwest and having a price bump in corn. At the same time, that same price bump, what it's done is it's making the cattle markets, they were soft as it was, and now they're just even softer. Uh, there we go. We finally did it to advance. So I don't mean to be just negative in all that I'm going to say today, but it's going to sound very negative, especially as we see these calf prices decline. I'm starting to, in my opinion, based off of what I think most people's cost structure is in the cow-calf sector, profitability is only going to happen for those that are really low-cost producers that are still able to add value to their calves in some form or fashion. You know, right now, a freshly weaned calf is only worth 700. A freshly weaned steer calf last week, 525 pounds, averaged about $730 a head. You know, when you take heifers being $100 back of that, if you have 50% steers and 50% heifers that you market, looking at $680 average return per cow if you have 100% calf crop. So I think it's tough to make money at those levels, given today's market. It's probably only going to get worse going into the fall. The good thing about margin operators is there are still opportunities, because even when prices go down, you end up buying on a softer market, and so there still may be some opportunities there. So let's just look at slaughter steer prices. We've seen a very, very typical summer slowdown in slaughter cattle prices. I had hopes. I'm not going to say I ever predicted it, because I didn't, but I had hopes that this finished cattle market would move above 130. It would show us a little bit more promise than what we see right now. But it never did. We had a really good flat market there, and if you've been keeping up with the finished cattle market, cattle feeders have been very, very willing sellers the past several weeks. They've been more than glad to get rid of cattle, and you'd say, well, why are they willing to get rid of cattle when prices have been going down? Well, it's the issue of a very positive basis. The futures market has continued to trade lower and lower on live cattle, and even last week, you know, with the finished cattle market trading around 113, 114, 115 type range, that's compared to a futures market for the June futures that said that we should be down 107, 108. And when a producer is looking, saying, well, in the future they're saying the market's going to be $6, $7 lower, well, that gives me an incentive to sell today instead of waiting until tomorrow to sell, because we're expecting lower prices. So a very positive basis is what has kept cattle feeders moving cattle through and sending them on the packers. Here's what we've seen in 5 to 6 weight steer prices. We had a very, very strong spring time period, just elevated out of the fall, and then May came, and since May, things have collapsed. You can see where we trade under $1.40. So essentially, you could take a 550-pound steer in this case and call him at $1.40, and that's what we're returning on that animal. Unfortunately, I hate, again, kind of like Aaron's talking about on soybeans, you know, it could get worse. This thing can get worse, and it's very likely I think we're going to bounce back from this 138 value that we had last week, but you know, bouncing back over 145 is probably not going to happen. And then we're going to see a fall time period that again goes back below 140, maybe even go down into the 135 range on these lightweight calves. Yearling type cattle, we just have not seen a whole lot of movement in them the entire year. You can go all the way back into November, and we just have not had a whole lot of the price range has been very, very narrow. We've seen some softening the past few weeks, and a lot of that has to do with the fact that the futures market, feeder cattle futures have dissipated to, we've lost $15, $20, $100 at one point, and we're still in that $15 lower than where they peaked. I'll show a graph on that. But the point is things on the futures market are not favorable. They're not indicating anything that's positive about feeder cattle prices or live cattle prices. And then you put on top of that the futures market on a corn standpoint. So live cattle are lower, feeder cattle are lower, and then you have corn prices higher. Well, all of a sudden, everything that goes into cattle production doesn't look very favorable to being profitable. So higher corn prices will only push feeder cattle lower than what they are. The one bright side is if you need to get rid of some cows, get rid of them now. Get rid of them yesterday. Get rid of them immediately. Whatever you can do, get rid of those slaughter cows. We had hit a terrible dry spell, which was prior to us officially starting this meeting. You know, we were kind of discussing that. You know, Les and Aaron were discussing it. I know here in the Murray County area, you know, a little over 3 inches for most parts of Murray County, and then you move over towards the southeastern part of Middle Tennessee, a little over 2.5 inches. Les said something about places in McMinnville having maybe up to 8 inches. You know, we had everybody got some rain, and this cool weather is going to help grass growth. But if you've got slaughter cows, cull cows that need to be gone, get rid of them now. Prices aren't going to get much better than where they are. We typically start seeing these prices start to decline after June, and we only have a couple more weeks of June. So no sense in wasting the forage that's going to grow the next few days because of these cool temperatures and good moisture in the ground. Go ahead and get rid of these cows, save that forage for somebody else, and hopefully it'll contribute to some more hay production or just grazable area. It's always positive to hit on, important to hit on slaughter and beef production. Heifer slaughter is up 8%, steer slaughter up 2.5%, and beef cow slaughter up 3%. What that's resulted in is beef production being up 0.6%. We've got pork production up 3.5%, which is a little ahead of what we had expected. The expectation was for pork production to only be up about 3% so far this year at this time period, but we're up 3.5%, and broiler production is up nearly 1%. You know, if we back up 1 second, we talk about all this increase in slaughter. You know, I want to point out that steers, we know steers are all going to slaughter. That's no doubt about that. But when we see heifer slaughter increase or decrease, we have to think about what quality of heifers we're talking about. And so when we were in that very quick expansionary phase of the cattle inventory, we start retaining all our good heifers, and even some of our mediocre heifers get retained to go into the cow herd. Well, now that profitability is very questionable, being a profitable producer is questionable, more people are going to send more heifers to market. And so all of a sudden, the quality of heifers going into the feedlot on average are increasing. You know, the low quality heifers are still going into the feedlot regardless. But now, as we start to see heifer slaughter increase, what we know for sure, and as we look at cattle on feed, placements of cattle on feed, and we see more and more heifers, we have to realize that higher quality heifers are going into the market than what were previously going in. And so we should see increases in production from those animals. And I guess I could have went through and showed some of the information, but we've been spending, steers have been spending a longer time on feed than a year ago. So actually about 10 to 15 days longer on feed is how long steers have been spending on those that were harvested in June. Spent 10 to 15 more days on feed this year than they did last year. They came out lighter than they did last year, and they were less feed efficient. I think they're based off the data. They were feed efficiency probably around 6.7 pounds of feed per pound of gain compared to about 6.1 a year ago. And so it's costing more to feed those animals. They're spending more days on feed, and they're coming off at lighter weights, which means in the feedlot, they're losing money on those animals. Those animals are not making them any money. And a lot of that had to do with the tough feeding conditions that those animals went through during the winter, with it being wet all winter. And now, again, we've gone through the spring, and it's been muddy pens, muddy pens, muddy pens. As much as this impacts corn, getting corn in the field, getting it planted, getting it fertilized, getting it sprayed, this same weather is impacting the large part of our feedlot area, primarily Nebraska, Kansas, moving into Iowa, where a lot of farmer feeders are. A lot of those areas have been just hammered with rain, and so you've got calves, you've got these cattle standing in mud constantly. But with this increase in all this meat, the per capita meat availability in the U.S. is expected to increase. That's not only from domestic production, but that's also from an import standpoint. We've been increasing the imports of beef relative to a year ago. The reason for that is the value of the dollar has increased. So therefore, these meats that we're importing are cheaper relative. At the same time, that increased value of the dollar also slows down our export market, but that's not the only thing impacting our export market. We'll briefly discuss that, but we are also starting to see a softening in beef demand domestically. And when I say a softening, I mean it's very, very marginal, but any type of decline in demand is gonna weigh on the market and gonna lower prices across the whole cattle and beef complexes. So you can see the dotted line, which is a year ago, and then you see the solid blue line there. Imports are actually very much in line with what we typically see, but the past couple of months we've seen increases in imports, and that a lot of that has to do with the value of the dollar. Realizing that most of what we're importing is manufacturing beef, so very lean beef that goes into grind type products. Whether that be on a fresh or frozen basis. Most of this is on a frozen basis. A lot of what we're importing is on a frozen basis, but it doesn't really matter. It's going to manufacturing beef of some sort, whether that goes into your taco or your burger, wherever you get your hamburger. That's what we're importing, and it's cheap right now. And at the same time, Australia is a very willing seller because they've suffered from terrible drought, and they've got a lot of meat on the market that they've got to move. The export side, we're below year-ago levels. I'm not concerned about us being below year-ago levels on the export side. It would be very beneficial to be able to move more meat internationally. But last year was a really, really good year, and exports so far this year are not bad. They're just lower than a year ago. The issues that we have started to see a little slowdown in movement to Japan. A lot of that has to do with the tariff rates. Here we're still sitting at 38.5% on tariffs, and then all the countries that actually Aaron's native country has benefited from what used to be the TPP. Now it's the Comprehensive and Progressive TPP, I believe is what it's called. But Japan is looking for high quality beef, and Canada actually produces high quality beef just like the United States. But they have a lower tariff rate, something like 27.5%, and that's going to end up incrementally declining over the next several years. Actually, I think it may be below 27.5%. There was supposed to be another decline, maybe in May. Maybe maybe it's down to 24% or something, but it's going to decline down to something like 9% over a 10-year period. Australia is a big market to Japan. We've also seen exports to Hong Kong decline tremendously. That has to do with China essentially cracking down. Aaron mentioned cotton going to, what did you say, Vietnam, Aaron, I believe, and then being turned into yarn and then going into other markets into China. Well, essentially that's, we were moving beef into Hong Kong, who was then moving it into China, and China's cracked down on that movement of beef. So all of a sudden we've seen huge declines compared to a year ago in beef to Hong Kong. Now we've seen tremendous support in South Korea. A lot of beef. We've seen increases in beef to South Korea. We still are doing a lot of business with Mexico and Canada. So not a bad situation there, but that all these trade issues that we see on the forefront are very important to the commodities that Aaron and I have been talking about this morning. If we don't see something change, we're going to continue to be pressured in our markets. Aaron mentioned something about soybeans. When you do look at the Chinese issue, the first thought is, well, a bunch of hogs are dying, so there's a reduction in the quantity of meat protein on the market. But at the same time, those hogs eat a lot of stuff. They have to eat something. Soybean meal is a big thing that we export to China for the purpose of feeding hogs. Believe it or not, it's also impacting the dairy market. Hogs, they use whey protein as a source. So whey, which is a product of milk, they use that in hog feed in China. Very, very commonplace for us to ship whey. Well, those exports have declined. So that's slowed down. I mean, milk prices have actually improved, but we have seen whey prices decline. And you would think, well, this reduction in meat protein should support other meat prices, whether that be our domestic pork prices, which we've actually seen decline. I think we saw this huge run up in hog prices, trade over $1 a pound on the futures market, and now they're back down in the 70 cents, 75 cents, 78 cent range. I don't think we're going to see $1 again in that market. People missed, if they didn't use the futures market to price those hogs, then they missed out on an opportunity. I'm going to talk about the same thing in the beef industry, where we're going to have to learn how to lengthen our marketing window. Aaron talked about marketing old crop corn, or old crop corn and soybeans in his presentation. And the thing is that there's crop producers out there that are still marketing old crop corn. Well, they marketed some last year and they marketed some last spring. There's people right now that are marketing old crop, and they're marketing this year's crop, and some of them are even marketing next year's crop already. And so, the thing about grains and oilseeds is they tend to be more storable and have a longer shelf life than our cattle. But we're going to have to learn how to find ways to extend our marketing windows instead of just only we're going to sell in August. So we've got, we can pick a week in August and we have 3 or 4 weeks that we might market cattle. We can't operate in that manner. But we'll get to some specifics on that here in a few minutes. The point is the international trade market is negatively influencing the beef cattle market right now, and not providing much support at all. Even though you see a huge decline in the wholesale box beef price here on this graph, packers are still making good money, and this is still a really, really high price for box beef, especially given the price of finished cattle. Finished cattle on a dress weight basis are around 187, 186, 187. So on a dress weight basis, 186, 187, and we're still trading box beef over $30, $35 higher than that. There's a lot of times that there's only about a $10 price difference in those two. And so the packer is still making a lot of money. They're buying cattle cheap, and they're still selling beef for a high price. And that's why we can talk about that beef demand being salted, because the consumer is still seeing high prices at the retail level. Those prices have not declined that much at the retail level. I don't have a whole lot to say about the feed situation because Aaron has already talked about expensive our corn prices going up, which I think should benefit most corn producers in Tennessee because a lot of corn producers were able to get corn in at a reasonable time period and a reasonable time frame. And so sometimes when bad things happen to other people, you know, we can benefit from them. And I've been looking at the corn and soybean markets pretty strongly, and I don't mean to step on Aaron's toes, but as far as the corn market is a good time. It seems like to me. There could be some more upside in this. So yeah, there's no reason to market 100% of your crop, but by golly, I think there's some profitability in there. But the problem is when you look at that, the people that I'm working with are the people that are buying this mess. And again, I sometimes I say you better buy because I still think there might be some upside in this corn market. Based off of the WASDE that information that Aaron showed earlier, I think USDA may change numbers again in the next month or so and say, hey, we're not going to have as much corn as what we thought back in June. Again, not saying going out there and price all your corn if you're feeding cattle, but if you're buying feed, expect the price to be increasing because corn prices are going up. You know, I guess the implications, we're still going to need more hay production. Overall, the national hay inventory is relatively low. We had some pretty strong hay production here in the state because of good moisture conditions. I'm not going to say it's all high quality. A lot of it was cut late. Some of it probably got rained on. But I think we can look at corn prices, and I guess the reason why I'm thinking about corn real strongly is because if we have a short crop this year that elevates prices, we're going to be dealing with those prices until this time next year. So we essentially are going to have a full year now of elevated corn prices of animals for this feed that's going into the feed. You know, these cattle are going into the feedlot. Don't expect any relief from higher prices on feeder cattle because corn prices are going to stay elevated, which are going to keep these feeder cattle prices soft. Here, this gives you a little idea of what I was talking about earlier about these cattle that have been coming off feed. The feed, you can see the feed costs per hundredweight on cattle that came off feed in March and April were very elevated relative to the previous year, and that did not have anything to do with corn price. That increase in feed cost had nothing to do with corn price because corn prices were still low during the entire time those animals were on feed. What that had to do with was those muddy pens, that feed inefficiency, more days on feed, and then we had these lighter weights. So all of a sudden, everything just went against cattle in the feedlot, and feedlots were not making a whole lot of money. And that's why they're not really willing buyers right now, is because they have to find a way to keep from losing $100, $150 a head again. Some of them probably losing $200 a head in some instances. So here's the August. If y'all are looking here at the August contract, and I just took it back to middle of January on this chart, and you know, so if you were planning on selling cattle in August, if you tried to price those animals anytime prior to about the 21st, 22nd, 23rd of April, you probably did pretty well for yourself. Any of that time, you could have priced them for $10 higher than where they are now. There's probably a lot of folks out there that don't have the ability to trade in the futures market. And I understand that because you don't have 50,000 pounds of feeder cattle to go into the market. But we have other alternatives, of which the one that I'm going to discuss was one that I would have not suggested anybody use because based off our research on LRP insurance, it was pretty useless. But they're making some changes to LRP insurance, and I'm going to discuss those changes. But this is the August. We traded as high as 160. a little over 160 on the August, and now we're down at yesterday we closed at 138.13. So you look at $22 lower than the peak, but what I see in this chart is I don't look at that price peak. I look at that fact that I had a 4-month window, actually longer than 4 months, because if I took this back farther, you'd see where we traded at 150 or higher for a good 3 to 4 months though. And so there was a nice marketing window there for cattle that were to be sold in August. And the problem is we don't take advantage of that enough. And if you know, at the time, if somebody would have priced cattle in February and at 152 or 150, 151, whatever they got them priced at, and then the price went up to 160 in April, man, there have been people kicking themselves because, oh, I could have had $10 more. I could have had $10 more. But you fast forward to today, and those same people that priced in at 150, they've already forgot about that 160, and they're so thankful that they have $12 more than what today's market is. And my point of this is it's not about hitting the top of the market. It's about hedging a price that's a profitable price. You know, if the futures market is not offering you a profitable price, and I think Aaron kind of alluded to this to some degree, like in the soybean market, he's like, you know, it could get worse, but I'm also not in any big hurry to market soybeans right now because the price looks terrible. Sure, it can get worse. So if you're afraid of it getting worse, maybe you want to market at today's price. And so, you know, to some degree, I think that's how we have to look at this, is because we can't wait till August to market these feeder cattle or live cattle either. You know, we have corn and soybeans, which are very, very storable. We put them in the bin in November or October, and they're still they're very much the same product come February and March. They hadn't changed. But we take a group of feeder cattle that we want to market in November. Let's go ahead and go to November. Here's the November. It looks very, very much like the August. But let's say we have a group of calves that we want to market in November. Well, if the price is not any good in November when we want to sell them, what do we do with them? Well, you can keep them, but then they're not the same product. Because when you keep that animal another 30 days, another 60 days, another 90 days, instead of it being a 750-pound steer, all of a sudden he's now a 900-pound steer. Or if you have a 900-pound steer, you can't afford to keep that 900-pound steer, so your alternative is to send him to the feedlot and own him in the feedlot. And now you're no longer marketing feeder cattle, you're marketing live cattle. And so you don't have the same product anymore. I mean, it may still be beef cattle, but it's a product that's constantly changing. And so we've got to figure out how we can lengthen this marketing window. Before we talk about the marketing window, I just want to throw up my fed cattle price forecast. It's really not terrible. I don't see this market as being terrible, but it's also not something that's going to result in huge profits. Here's what I had for expectations for freshly weaned steers. You can see the October-November freshly weaned steer prices are probably most important. Some people may hold those animals over into January. I mean, I've got some of these calves going down as low as 130 in October and November. So that's going to be tough. Then you can see my yearling cattle prices. I just don't expect them to change a whole lot moving through the rest of the year. We might see some small fluctuations, but not a whole lot of changes. So here's where I want to talk about the marketing window. So this is kind of it looks like a busy graph, but bear with me. The CME feeder cattle index, the red line is the CME feeder cattle index. So that is a 7-day, these are actual cash prices of cattle trading in 12 states out west, including Texas, Oklahoma, Kansas, Missouri, Iowa, Nebraska, the Dakotas, Montana, Colorado. What's just south of Colorado? I can't even, what state is that? Is that New Mexico? New Mexico. All those states are thrown into this. So every animal that's between 700 and 900 pounds Every steer that's in 700, 900 pounds, fits the description, makes up this red line. So these are actual cash prices. And then the dotted line is the nearby futures. So right now, the August is the nearby feeder cattle futures. There's 8 contracts for feeder cattle, and so throughout the year, the nearby changes based off of where we are in the time of year. So there's August and there's September. And so when August over, September will be the nearby, and then we'll fall into October and November, and then we'll jump back into January, March, April, and May. When you start looking at this, and let's just and when you see the 6 on the very far left hand, that is this. This is a year's worth of prices. So that's 6/2018. So that's June of 2018 to June of well, actually Friday. It takes you to the prices of Friday, which was June the 7th. So back on June of 2018, we were trading around 140 on the out west, and those prices reached as high as 157, 158. What I want to point out to you though is look at that nearby futures market. You see where that nearby futures market is showing a higher price than the index, so it's above the feeder cattle index. Well, when we see the nearby futures is higher than the current index, our expectation is for cattle prices to go higher. That's our expectation. Cattle prices should go higher. Cattle prices should go higher. Well, at that time, what kind of decision do you want to make? Well, you say, well, I think cattle prices are going higher, right? So what move am I going to make? Well, at that time, you could have easily sold a futures contract and had a higher price, right? Because you expect what we expect is for that red line and that dotted blue line to converge. All right, now the reason why there's so much gap here in the June, if you notice, it goes from the June to August, and then it finally converges in August. Well, that's because that was the August. We were looking at the August contract. So that August contract was saying in August, we're expecting these futures prices to be at 145. Well, then they kept on going higher. And as they kept on going higher, well, so did the feeder cattle index. And finally, when we got to when August actually occurred, they converged. The two converged. So feeder cattle index and the feeder cattle futures prices should converge and be the same when that contract comes due. And we can see how that dotted line and that red line have followed each other very, very closely. But then we come down here and you see that solid blue line, which is the August, this year's August, and it started trading last September. September 3rd, I think, is the actual date it started trading. I think it was that. Yeah, I think that's correct. But anyway, we see where it was very much in line with it. And then all of a sudden, and then I've got the November, and so November comes in there the first week of December. And so what we've got here is we got the actual cash prices of animals out west, and they're sticking in this 140 to 145 range. And this August and November markets are saying, well, prices should be higher, prices should be higher, prices should be higher. And when we see this type of price premium in our futures market relative to the current cash price, this is what I know. I know that those two prices have to converge. So if I had cattle back, if I looked at any time from January through April, and I knew I was going to have cattle to sell in August to November, I know those prices have to converge. And when we see that the cash price is really low relative to the futures, well, that gives me a reason to go ahead and sell cattle for August and November in the current time period. Because if I do that, either the cash price is going to move to where my futures market is, or my futures market has to decline. And if my futures market declined and I sold that market, then I'm going to be making money in the futures market. And so now we see, as we see this, the August and the November contracts have converged to our index price. They've converged to our index price. So when we look at this, the biggest issue I see with most of our cattle producers is we get focused on the calf crop that we have right now, and all we worry about is when we're going to sell those calves, and we're going to sell those in August, or we're going to sell those in October, or we're going to sell those in January. And then when those times comes, that's when we worry about what the price is. And in actuality, as soon as you get those sold, or as soon as the next calf crop hits the ground, you already need to be looking at the market to see if there's an opportunity to market those calves, so that we lengthen our marketing window, so that it's not just a month's time period. People had 4 months here to market feeder cattle for this fall at a much higher price than what they're going to be able to market them for this fall. That's not to say that every year you should pull the trigger on it, because this year it was an easy thing. It was a very easy decision, a very easy decision. When you have that huge gap, you're going to capitalize on the basis, or you're going to capitalize on the market moving higher. The actual cash market is my point. But there's a $20 gap in the basis there, and so there was essentially $20 to be grabbed, or $15, I guess, to be grabbed at any point. It was like $15 of free money on basis, because we know that had to converge at some point. I don't want to belabor that. I'll leave it at that. Here's the LRP. If you're not big enough to use futures, LRP, based off of the way it was previously set up, and I don't think they have not changed to the 20% and up to 35% subsidy, but LRP is going to be cheaper now. They're increasing the subsidy to the producer, so it should be cheaper to the producer. There's going to be more offerings of LRP. There's going to be more offerings based off the endorsement links and the number of offerings of the percent of a price that you actually can protect. I don't think the last one about annual head limits matters for most people, because most people aren't marketing 3,000 head per endorsement or 6,000 head annually. So I don't think that really matters. But I do think the fact that LRP insurance is going to get cheaper for producers is going to be a key factor in the ability to use that. And I think I'm going to do some work on that and try to figure out what the feasibility of using LRP is with these new subsidy levels. The thing of it is, it doesn't matter what the subsidy is. What matters is how much it's going to cost the producer per head. And I think as we increase these subsidies, especially at these higher rates, at the 30 to 35% rate, you're going to find out that it might be worth buying LRP insurance to protect prices. So with that,